The outlook for the US economy in 2015 is quite good. We're expecting growth around 3%, supported by improving business investment. Consumer demand should be enhanced by lower oil prices and the improving labour market. So in the rest of the world, growth is going to be more challenging. Europe is still facing a lot of headwinds, difficult relative price adjustments between the periphery and core economies. Monetary policy, which we think is becoming easier, but still is probably too tight, particularly for countries like Italy, Spain and Portugal. And fiscal policy and structural reform hasn't yet become more positive. So a year of a little bit stronger growth, but still very weak. Japanese growth is still being constrained by its supply side, so there's still been relatively few structural reforms that can drive potential growth higher, particularly in the wake of the still declining demographics. At the same time, monetary policy and fiscal policy will be very supportive. So the Bank of Japan's eased policy aggressively again in recent months. There's been a decision to delay the sales tax increase, and so that should mean that domestic demand is a little bit stronger. But we really need to get used to growth with a 1 in front of it rather than a 2. So emerging markets are really it's a market by market proposition. Chinese growth we still think is going to slow further in 2015, partly under the weight of the property market, partly under the weight of the rebalancing that needs to occur, but we're not anticipating a hard landing, just a gradual grind down in growth with policymakers sort of doing what they can and need to do to prevent a worse outcome. Brazil and Russian growth will also be very challenged in 2015. Russia by the sanctions that are applying and the decline in oil prices. In Brazil, monetary policies had to tighten again recently given high inflation. Fiscal policy is likely to become much tighter, and there are very few positive drivers for growth, particularly with commodity prices declining. The one large emerging market we're more confident about is India, that benefits a lot from weaker oil prices. Inflation's coming down quite quickly, which is allowing the Bank of India to take a more accommodative stance, and of course the new Modi government is starting to undertake some of the reforms, particularly on the fiscal side, that will create sort of more room for private sector growth.
Against the backdrop that Jeremy has described, we think the outlook is generally good for most financial assets in the coming year. Fixed income should do relatively well. After all, we're not going to be seeing aggressive interest rate increases by any central bank, indeed cuts in some. But we do think this is an environment still where assets like real estate and especially equities can do rather better. Now, clearly, as Jeremy has described, there are a number of headwinds facing individual countries, but two factors are going to be very important for equities and real estate next year. One is the decline in oil prices, very helpful for economic growth. Certainly it has impact on oil stocks, which needs to be examined carefully. And the other is the degree of monetary easing, interest rate cuts in China, the quantitative easing in Japan, possibly in Europe, all very supportive indeed for adding liquidity to markets, improving bank lending and such like. So generally I think equities and then real estate can do quite well in the coming year. The investment style has got to be bearing in mind the divergence, the sharp divergence which we're seeing between a number of countries and regions during the course of the coming year. We've talked a little about how some countries like the US should be raising interest rates, others will be adding liquidity to markets through quantitative easing. Different countries will be affected by oil prices. So very divergent moves between different countries, regions, and especially I think that will be seen in currencies. I'm sure we're going to be seeing just as much volatility in markets, whether it's driven by politics, geopolitics, climatic shocks, or whatever. The same sort of volatility in 2015 as we saw in 2014. So portfolios need to be thought about carefully from that point of view. All in all, we're really encouraging investors to be as selective as possible, to be active rather than choosing a simple passive environment for their investing. Often currencies is going to be the way that many markets need to be assessed. So be as selective as possible and do think carefully about risk controls and diversification against this sort of backdrop of very divergent and still volatile markets on a short-term basis that we'd be expecting. Well, the specific markets we like, starting with equities and real estate, our two favoured asset classes, We're looking most in those sorts of countries that can demonstrate some sort of growth, especially in corporate earnings during the course of the coming year. So the USA, Japan, to a lesser extent probably the UK. The profits, the cash flow, the dividends that these markets are able to deliver can be very significant indeed. Other markets like Europe and the emerging markets, certainly there will be a number of candidates there at a country or company level, but those investors need to be much more selective in. Within the fixed income world, there will be opportunities in dollar-denominated emerging market debt, in higher yielding bonds, infrastructure debt. There's a number of higher yielding fixed income assets out there, but clearly a number of government bond markets, even some of the peripheral markets in Europe, have now been driven down to quite low levels. And on a currency basis, we're very much in favour of a further appreciation rise in the US dollar next year, with therefore weakness in the euro, yen and sterling as well.